I thought something was off.
All right, welcome to the weekly meeting, January 13th. Y'all a little late. We've been talking already. Welcome, y'all, to all the late people. No, go ahead. Go ahead.
Yeah, we're talking about uh, the contraction, the monetary contraction that we went through for the last year. The only money that was printed last year was the 800 billion for the bank bailouts. What happened in March, right? So if we take that pattern, we may not be printing anything. It keeps the pattern, right? We should be printing in July, somewhere in that area. They were waiting for that last year, and it didn't happen. So that's the contraction that people are talking about. They're saying some people are saying that we're going into a contraction. We've already been in a contraction. We haven't come out of the contraction that we're in. How can you say we're going into a contraction when we've been in a contraction? So you have to really pay attention to what people are saying to you. Does it really make sense? Right? They did not print anything. Anybody who follows that knows that they have not printed anything for a year, and that's not normal. Right? So this year, it's supposed to be June, July, August, somewhere in that area, they're supposed to print. That's when they're supposed to print because it keeps the country moving, right? So we went out for a year. That's the contraction. So if they print it this year, right, that's like the stimulus checks coming in March. But when they did the stimulus checks, the market was at the bottom. It did a crazy push to the downside, and then they gave out the stimulus checks, and then it pushed the market parabolic. But then you came back and paid the piper right after that. That's the one percenters taking the money off the top. Now, as traders, we know when we buy low, we take our profits high. It's a one percenters mentality, right? That's if you've never had it put in words, that's basically what we're trying to emulate when we're successful. We buy at our lowest points, we take profit high. We sell at the highest point, we take profit low. 11, 12, 13 weeks of bullishness on the dollar, 11, 12, 13 weeks bearishness on the dollar into the 78. 12 steps ahead of the game. That's how you, when we say we're sure, but we're not sure because it's going to have to do whatever it wants to do. But technically, it's done everything that it's supposed to do. And it's technical analysts, traders who can see that better than a person that doesn't trade. They'll just go with what anybody else says. No, the chart tells you what you need to know. And then you get qualified sources that tell you about CPI and PPI and all those types of things. Those people aren't traders. They're just people who can give us that information that we need to apply to our technical analysis. And we get it, right? This year is going to be very special. If we get that crazy push to the downside, this 100-day flu that everybody's catching, it's like COVID. It's heading into March. We may have a crazy crash in March where they have to cut the interest rates early. But that don't mean that it's going to make the market go bullish. What's going to make the market really go bullish is the influx of the printing that they haven't done for a year. That's what's going to make the market go bullish. So they're setting it up to be in a problem area so that they can cut those interest rates and print money at the same time. It's going to be crazy. Right. So get your money ready, right? Get your accounts qualified so that when this happens, you actually are putting this money in your pocket and not trying to qualify your challenge. You still qualify your challenge, no rush. As long as you qualify the challenge, you're good. You're taking your personal money, personal account, whatever it is. You want to see this market at a low point. And we're going in this together. So we're going to see it together. We can sell the JPYs and we can buy the USD. So we're set up for success. Right. So good luck on everyone. Right. We're going to be talking about everything. So we're not going to miss anything. So stay tuned.
For sure, for sure. Let's move. Man, let's move to oil. Woo, Lord. Oil has been rejecting the 74th area for for the last month. Um, maybe the Houthi action, all this the stuff that's going on over there with those Houthi guys in Yemen will be enough to get us to a strong push up. Um, if you traded oil last week, you know we gapped up. Um, I don't remember what day that was. We gapped up. So Thursday, right? Thursday we gapped up. So anytime you see a gap, hopefully you expect the market to come back and fill the gap. Okay. So um, I wasn't tripping about the push down to close the gap. I do believe that we'll be pushing up. You know, maybe there's another gap next week, but um, we had to break through this bearish order block and this bearish order block. We broke through the first one. You know, this is not going to be a smooth ride by any measure until we break these order blocks back to back. And this, if you've traded oil or any other pair that has back to back order blocks, this is what I mean by it's going to be a bumpy ride. And this is where your technical trading savvy comes into play. This is why you don't buy in here. You see the gap, you don't get FOMO and buy up here. If you're buying at the top of structure, you expect to get wrecked because you knew price was going to come back. When price came back down here, now you can buy, right? Now you can buy because you only have a small runway. You know, I don't expect for us to break this swing low down here, but you have a small runway that you can contain your drawdown. If you buy way up here, then you're going to experience some pain, you know, when the price draws down. So if you're buying after pullbacks, right, or in the face of pullbacks, if you're monitoring your trade, you know, if you're in here for a long range, hopefully you're monitoring your trade from a higher time frame than the 4 hour. But if you're monitoring your trade on the 4 hour, I would keep my buying um, down to the red line, right? I'm not buying above the red line. And the way I look at this is a long range accumulation of of price, right? So over the long run, over the course of the next few months, more than likely, the price of oil is going to get higher and higher. And if you think about this, all of us drive cars. When is gas expensive? Every year.
Summer.
Every summer. Every summer.
Summertime.
Every summer. So if you're accumulating positions on oil over the next several weeks, if you just buy in point zero 0.01 every time it hits your line, let's say you're managing your trade on the 8 hour, right? And you're buying every time price touches your moving average, point zero 0.01. Eventually, you're going to have about 5 or 6 positions, and your first 2 or 3 might be down in this area. Now your account is on swole. And, you know, I would assume that as your account grows, instead of buying point zero 0.01, maybe you're buying a point zero 0.02 the next time it hits. And then you're buying a point zero 0.03. But as price walks up, you know, once we start getting into the 90s, you'll be like, man, this is crazy. This is the easiest trading I've ever done. Because without you doing anything, by you just holding a position, your account value just is just going to grow. That's not counting whatever trade you're taking that week. So the strategy and the concept behind the strategy of just accumulating those positions on the pullbacks um, will help you grow your account, and it will help you probably uh, understand how you can trade from a swing trade from a swing standpoint in the long run over time. You know, All right.
Beautiful.
Just understand we're still on the ground floor, right? Now a lot of us have positions from down in this area. Uh, this is still pretty low, but over the in the long haul of the move. But just don't FOMO once price pushes up. Wait for it to pull back. And understand the concept of managing your trade on a certain time frame. Go write it down. And you don't have to be a technically savvy person, but every time your trade touches your moving average on your management time frame, that should be your signal to buy. And it doesn't have to be perfect. Maybe you buy and it goes down another 50 cents. Okay, who cares, right? It's drawdown as part of trading. Just don't over leverage. 0.01, you know, as far as your account can handle. And then once it pushes up next time, you'll be happy. Don't buy though. Wait for it to pull back. Then buy another position. Wait, let it push up. Wait for it to pull back. And eventually the pullbacks will come down to 80. And your positions that you started with, your positions you started with down here will be swole by the time we're in the 80s. Everybody understand that? Anybody have any questions?
And you got people saying, "Oh, we want it at 67.50." They're telling you, right? I'm not going to say it's going to happen, but if it Judas swings, we're seeing Judas swing candles everywhere. If this wicks down to 67.50, I hope you catch it because I know I'm catching it.
Exactly. And what I think about that is it's great to get the very bottom, but this is January 8th, right? This is January 2nd. January 8th price ain't January 2nd's price. You got a higher low, you got another higher low, you got a third higher low. I I mean, maybe eventually we come back down here, but I wouldn't wait. I would not buy because I'm waiting on 67.50.
Yeah,
Um, I would look at structure, right? If I look at structure, we came from here, we got lower low, we got lower low. Now we got a higher low, and we got one, two, three more higher lows. So if you're a person who's waiting for price to come back down here, um, I just have to question how you're reading your market structure because in general, that's not how it works. This was the low. This was chalk. This was a 78% pullback to let you in the trade. And now we're challenging the highs of that chop. So what I would tell you is you're probably not getting 67.50.
yeah.
It's like me saying I'm holding out for Beyonce. And it's not me holding out for Beyonce, but the chances are none and never, for me to get Beyonce. So, let's be realistic. You can hold out for 67.50 next time oil crashes. But if we're just reading structure, um, I would be getting in. I wouldn't expect it to go past the lows that it is on now on this daily chart, 71.27. You know, but I guess that just depends on you as an individual. Maybe you feel like you missed the boat. Hey, whatever the case may be. But here in the next couple of months when we sitting at 80 and we're talking about it, just remember this is you had a chance to catch it $10 ago. Um, it's a slow, this is a turtle that's going to turn into like the Teenage Mutant Ninja Turtle by the time it gets to the top of this move. So not rushing you or begging you. We're just talking about what we see um, playing out and what we expect and how we can take advantage of it. So, you know, it is what it is. Maybe you see it that way, maybe you don't, but over the long run, that's just the way I see it, right? Um, Gold, I'm looking at gold coming back to this level at some point. Um, it's not saying it's going to be tomorrow or next week. That's not the case, and it's not even a smooth ride. So if you trade like this, you have to have some resolve and you have to have an understanding of your goal. You can't get caught up in the chats and you can't get caught up on individual posts and price fluctuating, right? We have to be able to put in a trade, put in a stop loss, put in a take profit, and let it do what it do. Because if we get caught up in the sidebars, then we end up, getting out and we hurt ourselves in the long run. When I like to go back and look, at these movements because this should serve as your confirmation, as a trader. Because if you're a person who doesn't believe in in what we're doing or what we're trying to say here, the way that you find your belief is you lay that fib out and you track the progress, right? So basically, this green line is the 50% where this candle needs to push up to. We're not at the 50%. But if you had got in this trade on January 1st and minded your business, you're up 161 pips. I get it. That's not a lot of pips. But your job is not to see how many pips you get per day or per week. Your job is to say, is this trade going to hit my TP? Right? So what I would submit to you is if you've blown an account this year, then your thought process should be if I had taken this trade, I would not have blown the account. I would be up 161 pips. So that's what I'm trying to kind of get people to understand. If you fib this candle, you're only up this many pips, but you've not blown any accounts. You know what I'm saying? So um sometimes it's the the goggles that we choose to view things through. If you had taken this trade, this one probably would hit your TP. GJ probably would have hit your TP. No, nobody would have blown an account because you're taking the trade from a more stable time frame. The money is slower, but the move is more guaranteed, more of a guarantee than these other moves. Y'all tracking? All righty, all righty. Um, Kim sent me a video on the inside bar. I think we had a conversation about inside bars. A lot of chatter around that. Um, an inside bar is a candlestick's way of letting us know that whatever momentum was in the market, it ain't there no more, right? So whether it's a up move or a down move, that momentum is done, And if you're if you're at the top or the bottom of the range, there's a high likelihood of price going the opposite direction. But let me see this video that Okay, yeah, this is the video here. This is a 36 minutes. It's a 36-minute video. We'll go ahead and watch.
Learning about inside bar trading strategy. Now you ask, what's an inside bar? Well, before we get to the inside bars, let's talk about Japanese candlesticks for a minute. Now, most people who enter the forex and CFD in the online trading market jump right to candlesticks. They take a couple classes, they read a couple books, and they think they got it down pat. Well, most of those classes, most of those courses, most of those webinars, including mine on the introduction to candlesticks, gives you a lot of information that is pretty useless. Because what we teach is candlestick recognition or candlestick patterns. And although these patterns have been around for hundreds of years, and they work fairly well in a much slower paced market. If you're buying stocks, if you're trading commodities, not in a CFD format, not when you're just trading for a couple pips one way or another, candlestick formation and the patterns they give you can work extremely well. But in our fast-paced online trading market, they don't work as well because what you're doing is you're just memorizing when this candle happens, that candle happens, that candle happens, they come together. You do this. And so that you understand it, I've given you in a handout on your screen the candlestick cheat sheet. That shows you the top 36 candlestick patterns, how they come out and what you're supposed to do with them and how they're supposed to help you trade. And that is simply memorizing and mastering pattern recognition. But for us, it doesn't really help that much because we have to be more concerned with price and fast-paced moving assets. So there's many other ways to use candlesticks because candlesticks are a great tool. Now, one of those ways, and there are a lot, there's indecision candles, there's tons of them, okay? There's tons of different strategies that employ different candlestick patterns or different candlestick reactions. I firmly believe that price action and seeing what price is doing is the only thing that's going to help you. And candlesticks can help you see exactly what price is doing. So we're going to be talking about what we're going to describe as the inside bar. So as the name implies, an inside bar forms inside of a large candlestick called a mother bar. Great name, mother bar. It's a pattern that forms after a large move in the market and represents a period of consolidation. This is why trading this pattern can be so profitable. You are essentially buying or selling a breakout or a continuation of the preceding trend. So notice how the second candle in the image is completely engulfed or contained by the previous candle. Here is the last candle, preceding candle. This is the current candle. And if you notice, the entire body of the candle, and this is called the body, is inside the body of the previous candle. So if you imagine this is mama here, and this is baby candle or the inside bar candle. Baby candle is within mama's, not her neck and her legs, but inside mama's body. So the inside bar or the baby candle is completely contained by the high and the low of the previous candle. Here is the high, here is the low, here is the entire candle, and here is baby candle. So notice how the second candle in the image is completely engulfed or contained by the previous candle. In this case, the bearish candle or the mother bar represents a broader downtrend, while the bullish candle, the inside bar, represents a consolidation after a big decline. Keep in mind that there can be more than one candlestick that forms and is also fully engulfed by the candlestick to the left. So you can have times where you have mama candle here, and then you can have baby candle here, and you can have another baby candle here, and you can have another baby candle here, because all of these are fully contained within mama. So at the minimum, it requires two candlesticks, two complete sessions. So you have always the mama candle and baby candle, but you have mama candle and twins, quadruplets. So as you can see here, we have many different slight variations, but they're all with the same definition. And so we have the mother bar and the inside bar. The mother bar and the inside bar, and then the mother bar and the inside bar. They're all fit the exact same definition, but sometimes you have great big candles, sometimes you have little candles. And they're the opposite color. And that is quite important. So what does the inside bar indicate? So in our graphic over here to the right, we have a strong bullish candlestick, right? Sorry. Okay, before we go on any farther, I need to explain something that some, especially new traders, don't understand. Because candlesticks were around a long time, since the 1700s. They were used by rice traders. But when I started trading, we didn't have computerized trading. We had some computers. Nobody had a PC. It was unheard of. Windows was unheard of. You had this huge air-conditioned room that we called the computer room that nobody went into except the one guy who ran it, a couple of people. And then you had this big fat monitor on a desk that was green in MS-DOS. And you had a choice. You want to see this report, you want to see that report. You push the button and it would give you, but you really couldn't program anything there. It was programmed by the guy who handled the computer. And that was it. So we didn't have computerized trading. We didn't have computerized charts. And back in those days, we sat in the pits and we had notebooks, binders with graph paper, and we only traded a few assets. I was only trading livestock back in those days. And you would sit there with your graph paper and your pencil, and you would draw each, and I'm a bar chart trader. I traded for bar. Most people did. Some people used candlesticks. And so in those days, we would put the high, the low, the open, the close, and form the candlestick. Now, if it was a bullish session, means the open was lower than the close, it closed higher than it started, is a bullish session, we would just leave that candlestick blank. If it was a bearish session where the open was higher than the close, so the price fell during that session, we would use the side of the pencil and color in that candlestick. So a lot of graphic representation and a lot of even names of the particular candlesticks are using the black and white. So like if you hear about 3 black crows, 3 white soldiers, okay. Today, because of computers, and today with the HTML chart, we can actually make them candlesticks any color we want. But they tend to come with the tendency of now green is replaced the empty candlestick, and that's a bullish session. And red, or in the old days, black, was the bearish session. So like here, you see this colored in green, which is the bullish, and the black candle over here isn't just because somebody just drew a black. It's because that is the bearish session. So when you see black and white, you should think red and green. So here, black is red, white is green. So let's step back one more second to be more precise. What is the details of a inside candle? Because in this case, the details do matter because you have to get it exactly right before you can get a trade set up or use it to make a decision. So let's assume our green mother bar here is the largest one in the recent price action on the chart. The market has moved with momentum, and the next candlestick on the chart can't take out the previous bar high and low. We can say that volatility has dipped or has dried up, and at this point, or at least it is not as strong as it was in the previous period. Well, that's a fairly good, solid assumption. So let's break down this inside bar for more detail. So we have the basic four components. We have the high, the low, and the open, and the high, the low, the open, and the close. This is what makes up every candle. So the inside candle focuses on the absolute range. The absolute range is the extent from the high to the low. Because there's a belief that when prices are moving up, they should be closing pretty close to the high. When prices are falling, they should be closing pretty low to the low. I don't know where that's coming from. Okay. So what is an inside bar, an inside candlestick? This happens as the move is digested. Remember, we have traders using all different time frames so that we could have traders taking profit from longer time frames, momentum traders bailing out because there was no follow-through, contrarians who were doing. So you have all types of people taking different positions. Now, there are more reasons, of course, but we can't cover all of those scenarios. Just the higher level ones. Understand that when you see this type of candlestick pattern, whether you're forex trading or trading stocks, you're looking at inside bar trading types of setups that depend on momentum showing up to carry the price through the high and the low of the previous candlestick. The candlestick looks strong because it's one of the only two candlesticks shown. We can say with confidence, strong bullish if the green candlestick is larger than most of the price action. That would have formed on the left. Okay. But when we have to look at it in a real chart with lots of things going on, okay, we have to see it's not so obvious. So we have to see what defines that inside bar candle. Now remember, trading this inside bar at this point isn't going to do you much good because the market's already here. Because you can only trade here at the wall. So you have to see it here. But remember, we're talking about the ultimate price. So we're talking about the high and the low. And then we're looking at the next candles. So once we define the high and the low, we can see we have two candles, one after another. Now, we could have just had one. In this case, we have two that are fully contained within that previous move. So a golden rule that you should follow is trading with inside bars. Do not trade an inside bar in isolation. Do not just say, oh, look, we got this, and trade. You need to be looking at all of price action. And we need to look at the psychology behind the inside bar. Since the inside candle has a lower high and a higher low than the previous candle on the chart, this indicates that the asset is consolidating. So what is consolidating? It is consolidating because the bulls cannot manage to create a higher high. At the same time, the bears failed to create a lower low. As such, there is not enough buying or selling pressure to break the previous candle's high or low. So let me share with you a little presentation that might explain it to you a little bit better. And then we'll go on and look at this on a real chart.
So as most of us know, a basic candlestick is made up of a high and a low, which indicates the complete range on the day, as well as the open and the close, which can tell us a bit about momentum, as well as who was in control of the day, whether it was the bulls or the bears. So the inside bars focus on the absolute range. We're concerned with the high and the low, not necessarily the open and the close. And what this shows us is that a range is tightening. We have a lower high and a higher low forming. So an inside bar is when the range of a candlestick fits completely within the range of the previous candlestick, showing a tightening range. So here is our mother bar. That is what we refer to as the candlestick with the larger range. And then the inside bar comes after it, and it forms a tightening range. If the inside bar were to come on the left side of the candlestick, that does not count, because we want to show through time that the range is tightening. We have a lower high and a higher low forming, and it's usually accompanied by a decline in volume, and it shows us that an equilibrium is being reached. Now, why does the high and the low matter? Because of that equilibrium. It's a tightening range. And if you were to zoom in on any time frame, and you will see these inside bar patterns on every time frame. So if you were on the hourly time frame and seeing inside bars, if you zoomed into the 5-minute time frame, you would see higher lows and lower highs with a tightening range. And that leads to a point, a flex point, where we eventually have a break because you cannot get any tighter once we see the range just shrink, 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 and then we have our break. And on that break is when we see a break and a spike in volatility with momentum as well. And it's significant because it gives traders a heads up what to watch for on that break. It's usually declining volume, as I said, the tightening range, and the break is with a spike in volume. Oftentimes, I recognize that a break is about to occur, not only because the price level is so very clear, but it's because the volume spike is accompanying it. So what we're looking at for a break of the inside bar, let's say these two candlesticks have completely formed. We have the range of the inside bar. And on the third candlestick, if we break the high of the inside bar, it's a bull break. And if we break the low of the inside bar, it is a bear break. So it is the price level, the high and the low that we are looking at to indicate the trade. Now, how do inside bars work? They develop in strong market conditions after breakouts or breakdowns. So you see a strong breakout, you see the price slow down and trade sideways while we consolidate. Here's an example right here where we have a large range candlestick on a breakout. Then we see a smaller range and a tighter range, two inside bars in a row before we finally get a bull break and continuation. So in this example, the bullish signal for entering the trade would have been the break on the second inside bar. As soon as the high of that inside bar broke, that's your bull signal looking for continuation to the upside. So the inside bar pattern, by definition, is showing us consolidation is occurring. And obviously consolidation most often occurs after a big move to the upside or a big move to the downside. So you can look at these and look at the macro or micro version. So the macro is the zoomed out version with just a few candlesticks. If this were the daily time frame here and we zoomed in, this is a micro version where we have, let's say these are half an hour candlesticks, and it shows us, rather than just a few candlesticks showing us highs and lows, this is showing us the range in between the highs and the lows, tightening range. It often occurs with triangle patterns or pennant patterns, but you don't even need to be aware of these trend lines because it's the high and the low that we are concerned with. And these trend lines are just a bit of a guide to show us when the flex point is coming as to when the break is most likely to occur, because we are running out of space and it's getting tight to the point where we know a break is imminent. So that's why these inside bars alerts are so significant, because it tells us, pay attention, things are tightening up, we're going to see a volume spike and a breakout from this tight pattern that we are currently in, and it's going to indicate the direction that momentum is heading. In this first example of inside bars, we're going to be looking at Apple on the daily time frame, and this was coming after a gap up on earnings back in February of 2017. So that is the preceding action being volatile and a strong move to the upside with big volume accompanying it. After that plays out, we see the volume drop off over the next 2 days and the range tighten. So the following day was an inside bar. You can see the high and the low completely fitting within the high and the low of the previous day, which is the mother bar. So we have our mother bar, our inside bar. Next day was another higher low, lower high, inside bar for the second day in a row. Volume dropped off again, just barely. And then on the third day of this pattern, actually the fourth day, we see a bull break over the high of the previous day and it comes with an increase in volume. And then from there, it showed us bull momentum, and the bulls continue to the upside. So we see a very clear pattern, and this is a very simple pattern. Once you get it down, you can pick out these inside bars very easily visually by looking at the chart. So multiple inside bars in a row. If we were to look at it on the hourly time frame, here is the run up on earnings, and then this is when the consolidation begins. It's a tightening range. We're trading sideways. Look at the volume. Each period of volume is lower, 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 and then it spikes with the bull break here. So we had our high of the original bull move, our low on the consolidation, our lower high then formed, our higher low, lower high, higher low. There's our break. So a way that I visually mark these out a bit better is I put some lines where the candlesticks ranges top out. So I can see the lower highs, higher lows, and then we just patiently wait for that break. And getting a little cluttered in there, so I would remove that one because this is the top of the inside bar, the most recent one. And then there's our bull break on the candlestick as soon as we break above the previous high, and that is a volume spike. And then momentum, look at momentum go. It's up to the upside. So on the daily time frame, the high of this second inside bar was at 129.19. As soon as we break 129.19, that is the bull signal for entering a trade, and then we see the follow through.
Now, that all sounds very, very simple. But the fact is, there are some characteristics that matter, because you can't just randomly see this happen and jump in and trade, and you'll eventually lose your butt. Okay. So if we can agree that there is no edge in simply selling or buying areas where inside bars show up, what type of strategy can we use? We can use any type of trading strategy. It's not an inside bar trading strategy, though. We are not trading the inside bar. We are trading location, structure, market mechanics, and using the inside bar as a trading entry strategy. So remember, location's just not for real estate. And this is a vital distinction. When we see that inside bar, it's also marking us our entry point, and then we have to wait for the next bar to reach that price, whether it's up or down, to make an entry. Okay, but we still have to understand and evaluate where we are in this world, because otherwise we're just going to make terrible mistakes. We're going to be more or less guessing. So look for inside bars to show up in areas where we can expect some type of price action. In other words, by having support and resistance lines on your chart as an inside bar, if an inside bar develops right on your support line or right on your resistance line, that makes it a lot more valid. And then if it breaks up and gives you a bullish break off of support, you then have a very, very good opportunity. So look for inside bars around support and resistance levels at either side of the trading range, even at the end of pullbacks against a trend. So remember that inside bars show us a lack of volatility as the move is digested. We're looking for a relieving of that pressure that builds up in consolidation to get us into a trade at a favorable location on the chart. So let's go step by step. First, on this chart, we saw a top. That was the highest price that the range had made in the run-up of price. We don't have an inside bar. We don't have a mother bar. We don't have anything as of yet. We see price push back into resistance, but we do not see the follow-through, which is something we'd expect to see at least a few candles later. Price has broken the support level that formed around B, and prices pull back towards what we may be potential resistance. But again, we do not we're only reading price action yet, because we don't have a mother bar and a baby bar, but we have to be reading what the price is telling us. What we're looking for is something to tell us, okay, we could enter a trade and what price we should enter that trade. So let me show you this on a chart so we can actually see what you're looking at.
On this next example, we're looking at gold on the hourly time frame, and we're going to find an inside bar here. We can see we're in an uptrend of higher lows and higher highs. We're trading sideways and consolidating, and we're looking for a break. And here is an inside bar. So we can see the range here of this candlestick is 1241.97 is the low, 1244.01 is the high, and the next candlestick on declining volume fits completely within that range. As soon as the high of this inside candlestick breaks, that is our bull signal. It comes with a little uptick in volume, and then the move that follows it shows the bulls have significant momentum to the upside. So as soon as the high of this inside bar breaks at 1243.66, that is our bullish entry. And if we were to zoom out and look at it on the 5-minute time frame, it looks a bit different, where we have our high, low, lower high, higher low, lower high, tight, 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 bull break on increasing bull volume, and then follow through to the upside. So same scenario, where I would be drawing the high and the low of the most recent inside bar to be watching. That is the range of the daily candlestick that formed as the inside bar. And then as soon as we saw that move to the upside, we saw a couple hours of follow through with big time momentum favoring those bulls.
Now, we talk about the daily and the hourly, but you could be using an hour chart to isolate them and a 15-minute chart to actually see them in more detail. There are 5 things that you want to look for when evaluating an inside bar pattern. Think of this as a checklist for trading inside bars. First, time frame matters. And for our type of trading, you can look at a 4-hour chart, then a 1-hour chart, and then a 15-minute chart. So, or just let's stick with the 1 hour. Take the 1 hour, find when an inside bar, mother bar and an inside bar form, draw your tops and bottoms of the mother bar, and then convert it over to a 15-minute, and those 2 lines you just drawn on there give you, and you can watch it when it breaks out of that range in the 15-minute chart, and that's where you would enter for our type of trading. So first and foremost, the time frame you use to trade inside bars is extremely important. As a general rule, any time frame less than the daily should be avoided for this strategy, except when you're trading in our type of market. This is because the lower time frames are influenced by noise. So you don't want to go down to a half hour and 15 minutes. An hour is the lowest you should go. You might even try a 2-hour or a 4-hour. An inside bar that forms in a higher time frame has more weight simply because the pattern took more time to form. So second, the trend is your friend. You always want to be looking for a trade in the direction of the trend. So the age-old saying, the trend is your friend. If you have been trading for any length of time, I'm sure you have heard this at least one, if not many times. As common as the saying may be, it has never lost any significance in the financial markets, especially when it comes to trading inside bars. So in fact, trading with the trend is the only way to trade an inside bar trade setup. So even though you may get a break upward that gives you bullish entry price, if the trend is down, do not trade it. Three, it's all about the breakout. The best inside bar setup formed just after a break of consolidation, where the preceding trend is set to resume. Remember, trend is your friend. For this reason, it is quite simple. A period of consolidation within a broader trend is the market's way of regrouping. In an uptrend, the consolidation is triggered when longs decide to begin taking profits. This causes a market pullback where new buyers step in and buy. So as we can see here, you can see that push. We have a uptrend that moved into consolidation. We have the breakout of the consolidation, and we have the continuation of the move up. So what we got was our mother bar with our baby bar, which gave us the price point in which we should enter, and that trade was been a bullish trade, and we would have traded here and would have ridden the rest of that trend upward. 4 is you have to always set your risk-reward ratio. A favorable risk-reward ratio is needed for any setup taken here This is true whether you're trading an inside bar, pin bar, or wedge breakout. Each and every strategy needs to be accompanied by a favorable risk to reward ratio. So what's a favorable ratio? It means always keeping your risk to no more than half the potential reward. So if you think you can take 200 pips, your stop loss can be no more than 100 pips away from your entry price. If using a more aggressive stop loss strategy, that means selecting inside bars that form near the upper or the lower range of the mother bar. This will allow you to achieve a much more favorable risk to reward ratio. That means, but it also gives you less opportunities, but you have to look for the specific setup and opportunity. And last, size matters. Last but not least, the size of the inside bar relative to the mother bar is extremely important. This idea piggybacks off the number 4 of the risk-reward ratio, where the inside bar forms an upper or lower range of the mother bar. In my experience, the smaller the inside bar is relative to the mother bar, the greater your chances are of experiencing a profitable setup. My rule of thumb, or what my eye looks for, is I'm looking for a big, broad mother bar and a tiny, and that's why I always call it tiny little baby bar. Because you know what, when you have a big, broad mother bar, and then you have a big, long second bar, you both have very big candles with a lot of movement. Doesn't really mean consolidation and a breakout. So remember that an inside bar represents consolidation after a large move. This is what makes the pattern so lucrative. The fact that we are trading a breakout after a period of consolidation. Therefore, the tighter the consolidation is, the more volatile the ensuing breakout will be. Of course, this isn't always the case, but in my experience, it holds true more often than not, especially when you get a small little baby bar. What doesn't matter when trading this particular pattern is whether the inside bar itself is bullish or bearish. In other words, if a market is an uptrend and the inside bar forms inside of a large bullish candle, it doesn't matter if that inside bar is bullish or bearish. Same is true when trading a bearish pattern. The only thing that matters is whether the mother bar is bullish or bearish. The formation of the mother bar in combination with the trend is what tells you which way to trade an inside bar setup. But remember, we're only going to trade in the direction of the trend, so you only have 50% opportunity because the other 50 may be a beautiful breakout, but we're not trading against the trend. So remember, we are not really trading an inside bar strategy. In this case, we are trading 2 strategies and using the inside bars for our entry point. So our first trade is actually a resistance holding trade. We are using the inside bar, the sign of lower volatility, to position short in that context. Keep in mind that the first trade is actually going against the trend that was occurring. So the question is, do we need a perfect inside bar? When the price action completes an inside candle on the chart, you should mark the low and the high of the inside bar consolidation range. These 2 levels are used to trigger a potential trade. The inside candle clues us into the eventual breakout likelihood of a continuation pattern. In simple terms, if the price action interrupts the range upward, then you should go long. If the price action breaks the range downward, then you should trade to the short side. So the question is, do you need a perfect inside bar? Well, I am a firm rule. I only want high probability trades. So I need everything to set up 100%. Because otherwise, you are taking a more risky trade. So it's important to make sure that you are taking the best trade possible. So if you want to learn more about using an inside bar as your trading trigger, you can do so by going to alvexo.com and going to their education center. But there's no doubt that inside bars can be a profitable way to trade the forex market. However, it isn't a setup.
All righty. There's a very long discussion about inside bars. You know, if you trade smart money, then that discussion was kind of a moot point. But if you are a not smart money trader, then maybe you got a little bit more out of that presentation. You know, but as a general thought, you know, you know when price is going into your level or your area, you know, that you have it going to, whether it's an imbalance or an order block. If you get an inside bar at those areas, then you know, it's just another level of confluence. All right. That's generally how I look at it. You know, here this past week we got an inside bar on a couple of pair, and we didn't get the move after that. You know, it's no big deal. Because the inside bar is just letting you know that the setup is there. The market still has to do what it needs to do, but because it didn't create the move, the order block, and the moves, so you know you don't take the trade. You know, it is what it is, and it looks like maybe we'll get the move this week, but you know, it just reiterates the fact that patience is probably one of the most important parts of trading, right? We can anticipate, which is awesome, but you still have to be patient enough to wait for your setup to either present itself or to validate itself, right? When you see the setup, you need your entry criteria to play out after you see the setup. And you know, if you see the setup and it doesn't give you an entry, then you don't have a trade. And we have to be mature enough as traders to look at it like that. You know, just because we see a setup doesn't mean we should hop into the trade. Do I have any questions? Comments?
I don't want to wait. I want to get in the trade right now.
Hey, I'm with you. You know, and trust me, I spent 2 years doing it. It
Hell
only
yeah.
cost me 60 grand.
Hey.
So you know, all the power to you. You know, it was a famous proverb. It said, "A wise man learns from the mistakes of others. A fool learns from his own." So you decide which one you want to do.
Yeah.
We all like to trade, you know, and it gives us a great adrenaline rush to see them numbers go from red to blue, or to get in the trade and they go straight blue. All that's great, and you know, it gives us an adrenaline rush. But at the end of the
Can I,
day, if,
can I, oh, go ahead, Kyle.
if we're blowing up the accounts, then it doesn't make a difference. Go ahead, Lil Kim.
So the purpose of, because when I looked into it, like the inside bar is pretty much like it is market structure, right? But for those who don't see or understand market structure, the inside bar is you're pretty much waiting for it to break out either the top of the mother bar or the bottom of the mother bar, right? So, and then once it breaks out, either way, whichever way it's going, that's the way you run a trade. It is still it's still market structure and price action. So
I
that's
agree.
kind of what I got from the video. So that's why I sent
Well,
it.
the
But I'm good.
I got that from the older guy. The younger guy in the video kind of contradicted that though, by the way he described to get into the trade. Um, and look, I mean, you can do it like that if you're trading a lower time frame. So, um, what he said was you have the inside bar, and Like in that example he gave, he had two smaller candles, and that third one broke the top of that smaller candle. They were still in the wick of that mother bar though.
Yeah, I don't agree with that.
Yeah, so it listen, at the end of the day, however you trade, like I think you can use inside bars as a verification, right? Um, I don't think that you should solely trade unless you just trade breakouts. If that's something you do and you just trade breakouts, that's cool. Because if you're on a lower time frame, that breakout probably goes to an equal high, or it's going to liquidity, whatever the case may be. But in our case, the scenario we had the other day, we were looking for a short, I believe, on the G pairs, and it didn't give us the move, but it looks like it's setting up to give us the move this week, right? Um, at the end of the day, for me, I'll just pull up my chart. For me, the market gave me the setup this week, and here's what I mean by that. If I go to this 2-week chart, me as a trader, this is my trade setup, right? I want to trade this pullback into the zone. Now, here's the kicker. This is my trade setup. Now, it's either going to turn and sell or it's not. I do have a setup, but it doesn't mean that I'm just going to jump in here for a short, right? What do I need to see? Maybe I need to see a double top. At some point, I need to see the chalk of us going, the opposite direction. And for me, that's going to start with maybe we push a little bit higher. Maybe we take out the liquidity from this high. Maybe I get a bearish order block. Then when I get my bearish order block and I get the push back into the bearish order block, maybe I can take it short from that point. The setup is there, but the entry criteria has not been met. So it's two different things, right? Just because you see your setup, that's step one. Once you get your setup, you got to drop down to whatever your entry time frame is, right? And you got to have your entry criteria met on that time frame. And sometimes I think that when we start trading, that gets lost in the sauce, right? If somebody's calling out trade setups, everybody's just hopping the trade. That's not how it works. I'm sorry, go ahead.
No, I agree. I agree. Way too fast.
Yeah, you can have a setup and then your setup doesn't play out. That just means you sit on your hands for however long until the next setup comes. But it's really the reason why I trade multiple pairs. Some people just trade one pair, which I don't knock. Whatever. But if you're trading one pair, you get a setup, and then your entry is not confirmed. Don't just hop in the trade because you're waiting to get in the trade. That's what kills traders. That's what feeds the brokers. So, I would just challenge everybody to add things to your toolkit, add things that you can use as confluence. And to me, an inside bar at the top or bottom of structure, to me, is golden. It's another confluence that the trade is setting up to go, in my direction. At the end of the day, when I drop down to that, Kyra, you sing very well. But whenever the trade sets up, I drop down to the 15-minute. Either I'm going to get an entry or I'm not. And if I don't get it, that's cool. I just move on to the next. It is what it is. So
Hey,
we just have to. I'm sorry. Go ahead.
Where was the original entry that failed? I forgot where it was at.
For
Where was
G,
the inside bar for GA?
it was on the daily. Hold on, let me go to the daily. This was the inside bar. We got this candle, right? And then we got the a fake down with a push up, but we never broke the inside bar, right? Now, you knew that we could go up and tap into this order block. There's a level that's marked here. But if it had turned and burned at this level, I mean that's basically inducement, if nothing else, right?
Yeah.
Comes to this order block and it fakes, then it goes higher to the next order block. But
But the point I wanted to bring up was that it did break out. It broke out and came back and retested. So where we thought it was a sell, it was actually a buy, and it still gave you the entry.
right on the lower time frame, like it
Yeah.
up move and a pullback. I wonder what time this was. Let me go down to the hour. I'm gonna have to mark it. This is likely a kill zone. London kill zone trade. So if you would have saw a structure, you see the consolidation, you see the break of this high, pullback, equal highs, come back to your imbalance, and then you go higher. The fact that this is 1 in the morning and it gave you a bullish order block,
It's beautiful, man.
sit up.
That shit is beautiful. Like what I would love for people to understand is what the inducement actually looks like. You have to see that, man. It's just so pretty. Like when that bottom left corner over there, when it hits that top level and goes sideways, that is seller's inducement. It goes higher, right? When it comes down and creates a L, it's the opposite. Like you get it down and then it's consolidation sideways, fall off the cliff. Get that in 24. Understand inducement in 24. It'll tell you to get the hell out the trade. That's one thing that it does tell you. If you think you have a sell and it consolidates for 10 hours, no, it's going to go high. They're not going to give you an opportunity to catch a sell for 10 hours in a row. It don't work that way.
I'm gonna see what this break is over here. You got two imbalances that this price can play off of. So if we tap this and pull back, I need to see it break this low before I get in it because it could just pull down and then go to the higher imbalance and sell. And that's still 200 pips. Kyra, that wasn't your sister. That was you singing, girl. All right. All right. Do I have any other questions? I didn't catch the beginner trading session. I mean, I was hurt. Apparently, y'all didn't talk about that. Y'all didn't talk about no inside bars in that, okay? Hello, can y'all hear?
No, we didn't talk about a thing.
What y'all talk about?
No,
Oh, y'all talk about the club.
yeah.
Yeah. While y'all talking about the club, the market structure, man, market structure is going to be the thing that sets you free. Before anything, you got to understand if the market is giving you higher highs and lower or higher lows, or lower highs and lower lows. Because at the end of the day, we make our money by understanding higher highs and higher lows, or lower highs and lower lows. And then you understand, you know, where you can take your move to based on those highs and lows. Are you in the middle of a range? Is it a daily range? Is it a weekly range? Is it a 4 hour range? Like, what are you trading? And once you understand that, your your win rate will probably skyrocket. All right. If y'all ain't got nothing else, I'm gonna get off of a Zoom call, man. Take me some of this Theraflu, man.
Oh yeah, I had to buy like 5 boxes. It's crazy.
Thank you, Todd.
You're welcome.
Good job. Good job.
All right, I'll catch y'all in the market streets.
Hey,